broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome. Well, we kickstart a new year, 2024, wishing you and your families a very, very happy new year. 2023 was a very good year for the equity markets, but above all, wishing you good health in the coming year. Hey guys.
And happiness.
And happiness.
Right. Happy New Year to everyone. We're bright and early, all ready to kickstart 2024 with all of you.
Happy New Year, folks. Happy New Year to all our viewers. Wishing that this year is healthy, positive, and it's filled with all things good for everyone out there. You know what's the best thing about coming to office on New Year's Day?
Please tell us.
You get to see the morning sun. Otherwise, imagine waking up by afternoon and, missing the morning. I was taking some positivity in from that. May that rising New Year sun fill us with hope and joy.
Absolutely. And never confuse the order, right? It's health.
Yes.
And then wealth.
Absolutely.
Right? So wishing everyone health above everything for 2024. And obviously 2023 was a good year for equity markets, and hopefully we have a pretty good year as well.
Absolutely, which makes the start of this year even more special because we literally are starting off on a high.
Yes.
But they also say that, when you are right at the top, then you need to be a little more cautious because there's always that risk of a bit of a fall. And I think that's how we're starting the 1st of January with a stupendous rally, 20% up in the Indian equity market, a 24% rally on the S&P 500, 45% on the NASDAQ. So very quickly, let's just dial back and look at the cues that we have in today. Of course, we don't have too much company in the form of other trading equity markets around the world. Pretty much the entire world is shut down. But for us, just to dial back, on Friday, we had some profit taking in the US market as well. Not just in India. We saw that tinge of red on Friday on our screens here. And that pretty much played out in the Western markets. So we had just a minor dip coming in on the S&P, on the Dow, and on the NASDAQ. But then, hey, who's complaining given the kind of year that we've had? Just to talk about some of the other cues, not too much moved in the bond markets. In the US 10-year was very close to that 3.8% handle. Cues are very, very thin in any case ahead of the New Year break. And ditto for oil. The good news on oil is that it came down to about 77 on Brent. So at least the fear with which we were looking at the Suez situation in the middle of December, that's been receding, and that continued on Friday as well. Now, I just want to talk about, a little bit. By the way, the dollar index is also around those 5-month lows. The dollar has been pretty well behaved. I just want to put up a couple of points for the yearly setup. How are we starting 2024? And there we're literally starting on a fabulous Goldilocks scenario, which, also makes you a little wary. But what's the Goldilocks? Well, for the US market itself, the setup is of this Goldilocks, that you will get a soft landing in the US. That's the biggest narrative right now. What I'm talking about is market consensus, that you will get that soft landing in the US, no hard recession, no major growth scare. And in addition, you'll get rate cuts from the US, which is why the US market has been rallying the way it is in the last couple of weeks. In India, we're expecting, if not, big rate cuts, but at least some dovishness perhaps from the Reserve Bank, a little bit of a let up on the tight policies that we've had for the better part of 2023. The general elections are perhaps the biggest event back home to watch out for in the middle of the year. And even there, the expectation is that you'll get status quo. And therefore, the positivity continues, and we got a glimpse of that in the state elections. Finally, by the way, on Friday, we had the Finance Ministry economic report come out, and that's saying all the right things as well. According to that report, we will be exceeding our 6.5% growth target for FY24 quite comfortably. That's the exact word used in that report. So the setup is so positive. And then let's talk about the flows. And these numbers, and they've been telling us a story all through December. In the last week, rarely is it that we keep getting a 4-digit buy figure in the cash market from the FIIs, and that continued the entire week right up to Friday, with volumes also being positive. That took the net tally, the FPI tally for December, to the highest we saw in the calendar year, over 66,000 crore rupees of net inflow coming in. So that deluge, that tsunami of foreign money that we started seeing in December, will that continue into the new year? That's a big question. Given that everything is so positive, I always look out for the risks, and perhaps some of the ones that we can put on the table right now, geopolitics for sure, oil prices and what happens there. But guys, as they say, the biggest risks are always the unknown ones. So if I could, I'd put a question mark as the third point there. Is there a risk that we are not accounting for right now? But hey, I don't want to be negative. It's the start of the year, so let's keep it positive.
Well, that's right. Surbhi, as you said, the money that's been flowing in, the kind of FI money that's been flowing, that's been very, very good, and it's been holding us in good stead as well. The bulls, though, they'll be hoping to get rid of this January jinx, so to call it, because the last 5 Januaries, well, we've ended in the red. And on an average, in fact, because a couple of them were a little bit harsher on the downside, the actual returns in the last 5 years is a negative 2.5%. And we know 11 out of those 17 Januaries that we've seen so far, well, it's actually been in the red. So the bulls will want to get rid of this January jinx, so to call it. How the FI is positioned, well, you don't like when they're positioned so much on the long side. The positioning itself is much lighter, so maybe the next 3 to 4 sessions, you'll get a build-up in terms of open interest as well. But for the time being, they're net long with close to around 84,000 of the contracts on the long side. The options data should come up for you. 22,000 call, well, that was fairly active, and that did see a mix of activity in Friday's trading session. And the 21,500 put as well. So just going by both those two numbers, I'm bringing in a near-term support at around 21,450. That's the level you should be looking at on the downside. And since the 22,000 call has so much of open interest, well, that becomes a bit of a resistance zone. The 20 DMA, well, it's far away for both the Nifty as well as the Nifty Bank. But if you want to take note of that number, in case the near-term supports a break, then those are the numbers that you're looking at. So let's see how we go from here. Yes, we have been in an uptrend. So shorting the market should not be coming to mind as well. The uptrend is very much intact. If you are a longer term investor, it's very clear. Keep your SIPs going, keep the money coming. In the near term, if you're a trader, well, it is still a little bit tricky out there. You'll have to trail your stop losses, and maybe you don't want to add too many long positions. Wait for the volumes to catch up, and then in fact maybe take a fresh call on the markets as well.
Well, we spoke to a lot of experts, right, through the course of last week, and we asked them the outlook for 2024, and they all said, well, we've had such a strong run. But, I want to just start this conversation on a positive note. Is it possible that markets can rally in 2024 after a strong showing in 2023? 2023, Nifty up 20%, mid-caps up 45%. So Hiren Ved, we were chatting with him of Alchemy on Editors Roundtable on Friday, and he said there are multiple instances when the markets have given successive years of very strong return. Go back to the period between 2003 to 2008, the mother of all bull runs, right? Even after a 74% return in 2006, in 2007, we had a 16% return and a 20% return in 2008. Moving forward between 2013 and 2017. Yes, there was one blip of, 2016 where things corrected a bit. The markets lost some ground. But look at, 13, 14, 15. We've had, after a strong showing in 14, even in 2015, we had a 25% rally. So is it possible? Yes, it's possible. History tells us that you can have multiple years of successive strong returns. Will it happen? Well, that's not a call that we're going to be making, not, forecasting the future, but just want to put that out there. The factors which are contributing, the Goldilocks scenario that, Surbhi was alluding to, sustained retail participation, the resurgence of FPI inflows, buoyant global markets, the US 10-year yield in 2023 had hit a high of more than 5%. Now we're below the 4% handle. Brent crude has logged its first annual decline since 2020 with a fall of close to about 20%. The key results in the key factors in January, if we have to break the January jinx that Nigel was talking about, one, the auto sales trickle in, earnings season. That starts with TCS and Infosys on 11th of January. That's next Thursday. And then on Friday, we have HCL Tech and Wipro. So next week towards the end, it's going to be all about IT. And then this year, you're not going to have the annual full budget. You're going to have a vote in account because this is the budget prior to the election. That takes place on the 1st of February. And just one final point in terms of flows, Surbhi mentioned that 1,460 crore in terms of FI inflows. Despite a negative close on Friday, not that we lost too much, both the FIs and DIIs were buyers. So irrespective of what's happening on the index, right? You go close up, you close down, the flows are coming through.
I think for the bulls this year, the biggest challenge as they start off is going to be to avoid the fear of heights. Psychologically, like you said, when you've rallied so much, you end up becoming cautious, but you don't want to miss perhaps some better times that could lie ahead.
And the last 2 months, actually, the rally has been very steep. Sometimes you're talking about, double-digit returns in an entire year, you'll be happy. You got it just, towards the end itself.
65% of the annual return of 2023 just came in November and December.
In the last 2 months.
But you have to make no mistake, if you're a longer-term investor, this is the India story. Just keep putting money. I'm personally doing that as well, keeping my SIPs going, trying to upscale them at times. So if you're a longer-term investor, no worries at all.
There's one
Keep the
more
money
risk,
coming.
this year, 2024, is going to be the election year. Forget India.
Yeah.
You
Yeah.
also have US, you also have European Union, which will be voting. There are nearly, 64 countries. Time magazine has reported 64 countries, 49% of the world population will be voting in 2024. So this is going to be the election year, the mother of all elections.
But I'm with Nigel on this one. Just see the way people are traveling around, spending, the way people want to upgrade their lives. The India story is well and truly intact. So on that positive note, let's kick it off with the equity call this morning, the 1st of January 2024. Gautam Dugar of Motilal Oswal Financial Services says after the sharp rebound, the Nifty now trades at a 12-month forward PE of 19.6 times, near its long period average of 20.2x. However, it is at 15% discount to the September 2021 high. Further, the market capitalization to GDP ratio is at 124%. Gautam says calendar year 23 was marked by multi-year high interest rates, concerns about banking crisis in the US and Europe, and geopolitical uncertainties. But calendar year 24 is likely to bring some moderation on these issues, especially on the interest rate front. With global liquidity tightening nearing its end, a healthy domestic macro and micro environment, strong domestic and retail participation, and expected political continuity post-24 elections, all of this bodes well for policy momentum in India.
Let's get you some money market views then. B. Prasanna of ICICI Bank says the dollar continued its softening trend and traded near year-low levels. The rupee underperformed and was stuck in a range as RBI bought dollars to recoup its reserves. Seasonal flows in the next quarter, improved trade data, and softening dollar makes the outlook for rupee positive in the medium term. He expects the rupee to trade in a range of 82.95 to 83.35 against the dollar for this week.
On bonds, Prasanna says global yields remained in consolidation phase amidst thin year-end liquidity. In domestic markets, continuous supply and tight systemic liquidity kept bond prices under pressure. State government announced much higher borrowing for the last quarter, which is expected to neutralize positive momentum arising out of improvement in liquidity in the new year. He expects bonds to trade under pressure with bare steepening bias and the 10-year benchmark yield to trade in a range of 7.15 to 7.25%.
All right, well, we got a lot of stocks that we're going to be tracking for you. We get to that in just a bit in our special Top 10 segment. For the time being, though, we run you through the list. We're looking at Bandhan Bank, Yes Bank, Grasim, ACC, BHEL, GPT Infra, KPI Green, Finiotex Chemicals, as well as Dhampur Sugar. All of them will be reacting to positive news flow, while you have Bodal Chemicals that could be reacting to negative news flow.
Okay, so we'll talk about all of these stocks in more detail in just a bit, but let's kick it off with the first market conversation of the day. Ed Yardeni, president at Yardeni Research, is with us. Mr. Yardeni, good morning. Happy New Year. Season's greetings to you. Hopefully, it's going to be a very positive 24 for you, for us, for all of our viewers as well. And that's my first question, that we're starting off looking at a lot of positives, and we were just discussing this, the possibility of a soft landing in the US, rate cuts and whatnot. Do you think it can really be such a good year for the broader economy as well as for stock markets?
I think the economic outlook for the U.S. economy is still quite good. We had better than expected economic growth in 2023. I think everybody's now recognizing that maybe we're not going to have a recession after all. I think the consumer is going to continue to spend. We've got some still strong capital spending because of onshoring. The housing market is likely to start to recover with lower interest rates. So the short answer is, yeah, I think we are going to see a solid growth rate in the U.S. economy. It might be better than expected if productivity continues to make a comeback, as it seemed to be doing in the second and third quarters. Globally, things still look pretty weak. China's Purchasing Managers Index came out on the weak side. Europe still in a shallow recession and will probably recover later in the year. But on the other hand, countries like an important country like India in the emerging market area is doing very well.
Ed, just to take forward the conversation that we had last week about U.S. rate cuts, the market is pricing or hoping or expecting for about 4 to 5 rate cuts. If the U.S. economy is indeed so solid, there is no need to aggressively cut rates.
No, you're right.
And your forecast was, I think, for 2 rate cuts. in 2024.
Yeah.
So will the markets, investors be disappointed by fewer rate cuts? Can that play a bit of a spoil sport?
Well, there could be some correction if and when the market starts to conclude that the Fed isn't going to be quite as easy as has been discounted recently. And I won't be surprised if Fed officials really come out talking quite hawkish, trying to convince people not to overreact here and anticipate too much of an easing move. But on the other hand, if it's only going to be 2, maybe 3 rate cuts next year, it'll be because the economy is doing well, with inflation down closer to where the Fed wants it to be. And so the Fed may conclude that the economy is resilient enough that keeping interest rates just somewhat lower is the right thing to do. I think they're still going to regret having been late to deal with inflation at the beginning of 2022. And I think they're going to, this time around, be a little bit more cautious about getting the markets overexcited about how low interest rates are going to go, fearing that easing financial conditions might revive inflation.
Hi, Ed. Good morning. First of all, a very, very happy new year to you as well as your entire team, and wishing you all the best in 2024 as well. But given the kind of rally we have seen, Ed, in the last couple of months or so, what's your approach to global equities on the whole? You know, we've had a very, very sharp rally, both the US markets as well as the Indian markets. So in terms of fresh allocation, what would the strategy be at this juncture, you know, between global equity markets as well as across asset classes?
Well, I think what we're seeing is that global investors are becoming a little less focused on what I call the mega cap 8 stocks in the US, the big technology companies. Some people leave out Netflix and call them the Magnificent Seven. But I think more money is starting to head out to other parts of the US economy and the global economy. We're certainly seeing in the United States a broadening of the stock market to small and mid-cap companies. So that's a very healthy development, reflecting the fact that people are less concerned about a recession and believe that interest rates are going to come down somewhat. And then, of course, people diversify on a global basis. And if it looks as though the U.S. economy is going to hang in there pretty well, Europe might have some sort of recovery, and maybe the Chinese government will come out with some sort of stimulus package. The rest of the world will look pretty good. And so we could see European stocks continuing to do better. India's done remarkably well and could very well continue to do so. I still prefer in emerging markets investing in India over China because I think we're still going to see a continuation of capital moving out of China because of geopolitical tensions with China over Taiwan and because of their restrictive policies on the domestic side.
Okay, well, that sounds good to us. We aren't complaining there, Mr. Yardeni. Finally, apart from geopolitics, and you briefly mentioned that, but apart from geopolitics and, God forbid, any skirmishes, wars, etc., are there any other risks that we should take on board?
Well, at this point, I think I would prefer not to look at other risks so much as the geopolitics. I think at this point, the geopolitics is the major risk, but even maybe some domestic political issues. The U.S. has gotten more partisan. The Democrats and Republicans don't talk to each other and kind of view each other as enemies in some cases. I do worry about some violence occurring as a result of that. The wave of illegal immigration into Europe and into the United States is something that could create some issues. But at this point, I think the most obvious risks are in the geopolitical realm, particularly in the continued Russian aggression against Ukraine, and of course the Gaza war.
Ed, we'll leave the conversation here for now. Thank you very much for joining in. Wish you a happy, healthy, and a wealthy new year. Thank you very much. We'll get into a break. On the other side, our list of top stocks is lined up next.
don't have too many markets in Asia trading, so can't tell you too much about the regional cues. But the overall cue is that we are starting off the year on a positive note. And let's see if we got that little bit of a cool off on Friday. So whether token trades this morning will start off optimistic or not. Right now, the gift is showing a little bit of red. We'll see how this plays out. Let's bring this down to the stocks then that we need to watch out for this morning. And we have our team standing by with the CNBC-TV18 list of top stocks for the day. Guys, good morning to you and Happy New Year, of course. Abhishek, let's kick it off then. You're watching out for Bandhan Bank as well as Yes Bank. Why is that?
Well, to begin with, Happy New Year to our viewers. To begin with, Bandhan Bank, they are transferring their housing finance NPAs to an ARC. These are overdues of more than 6 months or more than 180 days. So outstanding worth 720 crore nearly is being transferred, and they are receiving a consideration of close to 290 crores, which forms a little more than 40% of this transaction's total value. So this also forms about 2.7% of outstanding mortgage portfolio that they have. Sale forms about 65% of the outstanding NPS in the housing portfolio and about 9.1% of the total gross NPA that they have. So you may see gross NPA ratio coming down for Bandhan Bank on account of this sale of transaction that they have done. Yes Bank, they have already sold their NPAs to one ARC. Over there, they have received about 150 crore from a single trust in security receipts portfolio. So NPA sale was done to JC Flower on 17th of December 2022. The outstanding security receipts is about 2,353 crores, which forms about 1.1% of their overall book as of Q2 FY24. Back to you.
All right, thanks a lot for that, Abhishek. Well, let's focus on a couple of stocks. That's ACC as well as Grasim, because they've commissioned a couple of their units. So for ACC, they've commissioned a cement manufacturing unit at Amita, that's in Madhya Pradesh. The total capacity out there is around 1 million tons, and the commercial production has started. That's production as well as dispatches. So good on them. The other one we're looking at is on Grasim. They have commissioned an additional 1.23 lakh tons of advanced materials. That's in Gujarat. With this, they've doubled their capacity of the advanced materials, because earlier it was around 1.23. Now, in fact, it's 2.46 odd. So expecting a tinge of green on both of them.
Moving on then, BHEL could be one of the big movers of the day. Vivek joins in for more on BHEL, GPT Infra and KPI Green. Vivek.
Well, good morning. BHEL has definitely started off 2024 on a very strong note. So newspaper reports indicate that the company has emerged as the lowest bidder, so L1 position. Now, this is for the 19,422 crore project from NLC India in order to go ahead and construct the supercritical thermal power plant at Talabira. Now, we've reached out to both BHEL as well as NLC India to confirm the news. We are yet to receive a response from both of them. Remember, at this point of time, H1 24, order inflows for BHEL has been 33,000 crore, one of the strongest on record for the company. Order backlog is well over 1.14 trillion. Now, the other stock on the radar is GPT Infra. The company again has received an order win, has emerged as the lowest bidder in an order for over 265 crore. This is for construction of a 4-lane bypass as far as West Bengal is concerned. Watch out for both of the KP group stocks, KPI Green as well as KPI Energy. Both of these companies have gone ahead and declared bonus shares in the ratio of 1:2 to their respective shareholders.
Okay, got that. Vivek, thank you very much for those stocks that we're looking out for. With that...
I think Sonal.
Okay, Sonal, yes. Over to you now. Which stocks are you watching out for today?
Well, I'm watching out for 3 stocks. Let me start with Finiotex Chemicals. The company has acquired additional factory land premises. It is at Thane, Maharashtra. It is around 7 acres of land, and the company will be adding it to their overall asset portfolio. The total investments will be 35 crore rupees, which the company will be funding via internal accruals. Additionally, they've also set up a wholly owned subsidiary, which will be called FinoClean Specialities Private Limited, and has been incorporated on December 30th. Bodal Chemicals, while there is good news in terms of commencement of commercial production at their Unit 5, which is located at Sakya, India Ratings and Research, they have downgraded the credit ratings of the company to BBB plus negative. So that could be a dampener for the stock. For Dhampur Sugar, it is a positive news because the board will be meeting on 3rd of January. This is to consider a buyback. So these stocks on our radar today.
Okay, thank you very much for that. And watch for Zomato also, because the company has announced that on 31st of December yesterday, they saw record orders. Not surprising, I think even last year they had said that it was a record, but it looks like 2023, 31st December beat even those records. So Zomato could be another stock that should be on your radar. A quick recap then of the top stocks. Stocks with positive news flow are Bandhan Bank, Yes Bank, Grasim, ACC, BHEL, GPT Infra, KPI Green, Finiotex Chemicals, Dhampur Sugar. The only stock which is on our radar with negative news flow is Bodal Chemicals. We will slip into a very short break. On the other side, we'll invite Prakash Diwan to talk about some fundamental stock analysis. We'll also be joined by Nitin Panwad, Group CFO at Vaibhav Global. Welcome back. Day one of 2024, 1st of January, the GIFT Nifty is suggesting a bit of a muted start. A quick recap of the trade that happened on Friday. The Nifty and the Sensex ended in the red. The Nifty closed above 21,700, 21,731, just about 40 points away from its all-time high levels. But the rally in the mid-caps continued on Friday. The mid-cap index was up 0.8% on Friday, taking its year-to-date rally to 45%. But let's get you a roundup of all the action from the world of commodities. Manisha joins us this morning. Manisha.
Morning, and thank you. And a very happy New Year to you too. And we are looking at a strong start to 2024 as far as the gold prices are. 13% of gains is what we saw in the previous year, hitting a record high. And a first annual gain, by the way, in 3 years. Dollar index decline of 2% in the previous year also has been quite supportive. And with the markets expecting more rate cuts this year, and there is also support from the geopolitical tensions, is what has been supportive for the precious metals and the industrial metals, that is, have also started on a positive note. Of course, we're looking at very low volumes. We are perhaps the only country which is working full-fledged. But even between the lower volumes, the metal prices seem to be doing well. A good news clearly in sense of the crude oil prices, which fell 10% in the previous year, have started 2024 also on the negative side. There are ongoing concerns on increasing global supplies and weak demand. The markets will also watch out for the output cuts from the OPEC itself, which is 6% of the global supplies. All of those details as we see developing going forward.
Okay, all right. Manisha, thank you very much for wrapping up all the cues. Indeed, yeah, let's hope that oil behaves itself. We can really do that here in India. Thanks for joining in. With that, let's kick off our market conversation for the morning. We have Prakash Diwan joining in for exactly that. Prakash, good morning to you and wish you a very happy new year. May it be good in every way, health-wise, home-wise, and of course, wealth-wise. So, Prakash, let's start off with a couple of cement stocks. I want to pick that up because, Nigel was just mentioning a couple of the bigger names that are adding more capacity. Plus, then we've been getting some positive brokerage commentary as well on the likes of Dalmia Bharat. But in general, what's your sense? While thematically, obviously, this is a space, perhaps a must-have in your portfolios. But near term, what would your expectations be? And how would you look at some of the larger frontline stocks, if you like any?
Yeah, thanks, Purvi. Happy New Year to you, Nigel, Rima, and of course, all our lovely viewers. And it's an inspiration to see Nigel every 1st of January back to work as fresh as ever. So that's what prompted me to be on the show as well. So,
yeah,
Prakash, and you're talking about cement.
Prakash, the last few years I've been here. I'm just making a plan that next year I'm trying to break that so-called, that attendance has been very good last 13 years. Every Jan 1st I've been here, bright and early. But let's see, maybe 2025, I'll take a bit of a break.
No, that's fine. But you've been inspiring enough for all of us to at least get up and come to work. So that's nice. On the cement side, we're talking about this thing, and of course, Dalmia Bharat, as you all know, continues to be one of our favorites, given the fact that not only has it managed extremely well on the cost side, they've also done some balance sheet repair, which is not repair, they never actually needed repair, but they've strengthened the balance sheet, hiving off some non-core assets, making sure that the cross-holding with some of the group companies come down. So from a corporate governance perspective, related party transaction, it's also become much more sanitized in the last 18 months. What I like about the space, Surbhi, and we've seen some of the bigger ones like ACC and all are also adding capacities. So if you recall about a year back when Ultratech and all were talking about adding capacity, there was so much of skepticism saying, how is this supply going to get absorbed in the market? But there's been absolutely no question of that coming up again, given the fact that our infrastructure and housing requirement for cement is going to be in a secular uptrend for the next many years. So all this capacity which is coming up, brownfield, some of them greenfield. Greenfield is uncommon, but the consolidation that's underway will also help reap a lot of benefits on incremental capacities from the likes of Ambuja ICE. So if you want to go with the bigger ones, Ultratech seems to get fully priced. I would look at Ambuja in the bigger ones, and amongst the mid-sized one, Dalmia Bharat continues to be one of the topics.
Prakash, 2023 was the year of the comeback for a stock like BHEL. The stock is up 140% plus in 2023. Its all-time, the 52-week high on BHEL was 199.7 that it hit just last Friday. So it missed the 200 mark. Yeah. But there is some good news. The reports are suggesting that they've pipped L&T to emerge as the winner for a 19,000 crore plus order win. So they've started off 2024 on a good note. Do you like BHEL? What would be the key positives, the negatives from here on?
Good morning, Rima, and happy New Year to you too. So on BHEL, we've seen the build-up has been stupendous. Their order book kept on growing so significantly from middle of 23 that if you look at by March 24, the culmination of the financial year, they'll probably have a comfort of 5-6x of what they are executing currently at the run rate. But, and then I was a bit skeptical about talking about buying BHEL at even about 150, 160 zones. But then I've been proven wrong given the fact that the momentum continues to be on. And it looks like the momentum will still be on. So if somebody is holding, it might make sense to ride the momentum, given the fact that they'll probably close FY24 with a brilliant operating leverage coming into picture. So we'll see those numbers in December 23 and March 24 getting captured. But I think the stock is in a momentum. It could continue for some more time. The only concern I have is on execution and what L&T went through a few years back when they actually were busy executing low margin orders. So if BHEL also ends up doing that and L&T switch focus to exports, high margin business very selectively. So, there's a change in strategy which you are seeing in both the names. BHEL might continue good revenue build up, but if profitability beyond March is a question, then the stock would kind of react. But at this point in time, it definitely seems to be, the momentum seems to be underway.
Okay, all right. Prakash, request you to stay with us for a bit. Let's welcome our first corporate on the show. We're joined by Vaibhav Global now. The stock had a decent run in 2023, remind you. It was up close to around 30%. They're targeting high teen growth in FY25, and also they're aiming to deliver around 13 to 15% revenue growth in FY24. Mr. Nitin Panwat, the Group CFO at Vaibhav Global, joins us on the show. Hi, Nitin. Morning. Thanks so much for joining in and wishing you and your team a very happy new year and all the best for 2024. Well, I'm just looking at your recent disclosures, and there are two acquisitions that you'll have made, Ideal World as well as Mindful Souls. How do things shape up out here? How will it help? Will it help in terms of market share gains? And also, what kind of a revenue contribution can it give to you?
Sure. Yeah, good morning, and thanks for having me here. And Happy New Year to you and all the viewers. And yeah, starting the first point that you mentioned about the recent acquisition that we have done it, the first asset purchase agreement that we have done to take over the brand of Ideal World, which is operating a business in UK in last 21 years, even before we started business in UK. And pretty good customer base they have it and the household reach in UK. That brand came up in the last quarter, end of the quarter, and then pretty decent price we have got it in this acquisition around 1.125 million, almost 11.5 crore rupees we have paid it for the acquisition. We got it their IP rights, broadcasting rights, their studio equipments and some IT equipments that we have got it. And that brand actually was doing in trailing 12 months almost 60 million pounds. But we don't foresee that turnover will achieve sooner, but our first target is to make this business profitable first. So that is why we have given the guidance that within 12 months that we will make this business break even. And then later on that will increase our operating leverage and continuously increase our market share. And we expect that the 60 million revenue in that business will achieve in 3 to 5 years. And the other acquisition was more a D2C company, which is Mindful Souls, purely in e-commerce base. And they just started business 4 years back, and pretty robust turnover. We have seen it from 3 million euros to 18 million euros growth in past 4 years. And good operating leverage, or around 10% PBT margins they are having it. So we see that the second acquisition, Mindful Souls, not only our vertical integrated supply chain benefit, we will have it to improve the profit margin, but also that the digital learning that we will have from this brand, that they are acquiring profitability customer through social media, Google and other media platforms. We will do a synergy between the existing brands. So we'll grow not only that business, but also our existing brand to expand our digital shares. And we have paid roughly around 12.5 million euros. We have agreed the deal, and almost 75% that we have paid, remaining will pay in next 2 years. And I'm pleased to inform that it is all funded through internal accruals, which shows the robust business model that we have, pretty good cash generation business model. So in UK, the first brand ideal world to expand our market share in UK, and the other acquisition D2C to not only expand the revenues and profitability, but also having a digital learning within our existing brands. And we anticipated that this financial year, that the guidance that we have revised it in the last quarter, from 8 to 10% to 13 to 15% pertaining to these both of the acquisitions.
And any guidance, Nitin, on margins for FY24 and even FY25? Because you did say you are looking to improve the profitability of one of your acquisitions. So can there be an increase in margins next year? So the guidance for this year and next on margins.
Yeah. So in terms of margin side, so there will be operating leverage continuously. We'll see. However, normally we don't do guidance, but it is continuously improve our margins. Recently, quarter over quarter in past 5 quarters, we are seeing the improvement in profit margins from 6% that we are reporting. Now it is almost 10% that margin we have reported recently. And it will continuously to improve our margin performance as we are improving our revenue line, because our business model is very beautiful. Most of the costs are the fixed. So once we see improvement in top line, there is always a operating leverage comes, and there's a margin improves automatically.
Just a word, Nitin, also on your B2C mix versus B2B, because I think the objective that you've laid out is that you want to grow the B2C business as well. How do things stand right now, and what is your projection FY25? By how much would you want to scale up the B2C business?
Yeah, so our business is more a B2C only. B2B is just an opportunistic business. B2B is just we do only a couple of percentage of overall business. B2B we have B2C we have two categories. One is television shopping and one is our digital platforms like website and mobile apps, OTT apps that we have it. So television shopping business is continuously growing, but as the digital business and the worldwide growth on digital business is much higher and TAM is pretty high on it. So we are more focusing and doing investment to expand the digital share. Right now, our digital revenue mix is almost 39%, and we are targeting to increase that share to 50% by FY27. There's a lot of initiatives behind that. One of the acquisitions that I just mentioned about the Mindful Souls to expand our digital share, and also the learning that we will have through this acquisition, and also focusing on lower customer acquisition cost. And the investment that we have done on Salesforce marketing clouds and service clouds to increase the digital share.
All right, Nitin, we'll leave it on that note. Thank you very much for joining in, and once again, wish you a very happy 2024. That's Vaibhav Global. Prakash Diwan, of course, is still with us. Prakash, I just want to ask you in general, if someone's looking to play consumer discretionary in 2024, not specific question to Vaibhav Global, anyway, they're more global in their businesses, but discretionary consumption, what would be your top bet?
So I know it's a fairly vast area, but I personally feel within consumption more than discretionary, the FMCG is something which seems like getting re-rated or due to be re-rated. So all the big ones, the likes of HUL, Dabur, ITC, all of them will probably see a very different kind of a liquidity flow chasing them. But if I had to look at discretionary, so it will probably be autos. I know. It's a very extended kind of an argument, but consumer discretionary autos definitely fit into that, and especially the higher end, and that will continue to do well. I'm extremely bullish on autos, and within that, Tata Motors. For Nigel and I spoke about it last week, and you've seen how the kind of momentum is building up within Tata Motors, and come March, they restructuring will probably start capturing a lot of the salience. The margins will improve dramatically with this interest cost going out. And the cost of EV components is coming down so dramatically that they'll start being able to get some very decent operating leverage on most of the models. So, and of course, not to say that they have such a slew of new EVs coming through 2024. So I would still believe in that and not go for the white goods and some of the other conventional consumer discretionary stuff that's generally talked about in that sector.
All right, I thought you were going to come up with a more exciting one, Prakash. I remember the last time, maybe 12 months or so ago, you were telling us about Som Distilleries, the Hunter beer brand. Can't get my hand on the chilled one, but the stock price has done very, very well. But maybe as the year progresses, you'll give us a couple of those interesting stocks as well. But stay with us, Prakash. For the time being, we'll slip into a short break. We come back, we'll have Shrikant Chavan of Kotak Securities, as well as Sudhanshu Sukhani, who will be joining in to give us their technical trades. Welcome back. Hope you're having a good morning. We're set for the first trading session of 2024. So let's see how this goes. 2023, mind you, was a very, very good year. But for starters, the Gift 50 at least suggests that maybe we'll pull back a wee bit. But as promised, let's get in our technical experts. We have Shrikant Chavan as well as Sudarshan Sukhani, who joins us on the show. Good morning, gentlemen. First of all, a very, very happy new year to you as well as your family, and wishing you all the best for 2024. Well, Sudarshan, we've had a very, very good run for the last couple of months. But how do you approach Nifty from here on? The gift Nifty is suggesting a bit of a dip. What are the levels you're looking at?
Yeah, good morning and a happy new year to all the viewers. Well, 2024 should be like 2023. There will be bursts of big rallies. Of course, we don't know when, whether it will be January or December, that is unknown. But I think we'll end up higher. But that is just, more of crystal gazing. For today, I think the view is we've had a big rally. Now, 2 narrow range days have already come by on Thursday and Friday. That should continue. January is usually a choppy month after a seasonally bullish December. So I would expect markets to chop around a lot. So for traders, the trade is still to buy, but there's no rush. I think you should have a lot of patience, look for significant intraday dips to go long, either intraday or positionally, but don't buy breakouts, buy only dips. That applies to the bank Nifty also.
So Sudarshan, what would constitute as an appropriate dip on the Nifty and the Nifty Bank to go long? Because the dips have also been fairly shallow. So, just for the near term, any levels?
There are no levels, but usually a 100-point dip from the open justifies buying for the short-term trader. That's just a usual rule. I mean, don't make it very hard. But the important point is that gives us a sense that, okay, the markets have come down today.
Got it. So 100-point lower from opening levels. We have Shrikant Chauhan also with us on the show. Shrikant, morning, season's greetings to you. A very happy new year to you and everyone in Kotak Securities. What would your approach to a trade be, and what's the setup looking like for the near term?
Yeah, good morning. I would like to wish you, your team, and all the viewers a very happy new year. I think the way we saw a spectacular rally in the year 2023, I think this 2024 will be the year for stock-specific activity. And we need to be more and more focus on these sectors and stocks where we can get a lot of opportunities to trade for. But for the index specifically for the day, yes, as Sudarshan said, 21,600 going to act as major support for the market because it is just 125 points lower from the previous close. There, the market has spent a lot of time in the previous week. So 21,600 should act as major support in today's date. We are expecting market to rebound from those levels. But at the same time, on the higher side, 21,800, 850 will act as major resistance. So we are not expecting any major activity, but yes, it is going to consolidate within the range. And for the Bank Nifty, 48,000 and 47,900 is the area of support. From there, again, we can expect some rebound in today's day.
Shrikant, go ahead. Then you've given us the index call. What about individual stocks?
Yeah, I think, there are a few companies which are really good and they are absorbing selling pressure, mostly from the commodities side. Tata Steel, which was failing to surpass the level of 140, is now managing to absorb the selling pressure. So from here, the stock can again move to the next all-time high levels of 153. So Tata Steel is a buy at current levels with a stop loss at 134. We also like ACC, which is around 2200 levels. There also we saw a monthly reversal activity, and based on the formation, we can expect 2400 on the high side. So ACC is also a buy at current levels with a stop loss at 2150. And finally, we like GMR Infra, which is above the level of 81. So from here, the stock can move to the levels of at least 87 or 90 in next 1 or 2 days of time. So GMR is also a buy at current levels with a stop loss close to 78.
Okay, got that. Gentlemen, good morning. Surabhi here, and Happy New Year to both of you. Shrikant, thanks for those picks. Sudarshan, let me come to you. Which stocks would you trade today?
Well, there are a lot of stocks still giving opportunities, and that's good. Berger Paints is a buy. It's just come out of a 2-month consolidation. I think there's much more upside here. It's more of a positional buy. For intraday traders, keep a stop under 595. Dixon is a buying opportunity. The stock has already been rallying. It went into a consolidation last month, and it's on the verge of breaking out from it. Granules has a similar chart, big rally, 1.5-month consolidation. It's a little choppy. Pharma stocks are usually like that, but still it's worthwhile looking at a buying opportunity. And then finally, I have IndiaMart, which is an intraday short. Now, intraday short should be done carefully. Short selling should never be carried over. But consider selling it with a stop under above 2760.
Okay, all right, gentlemen, thank you very much. We'll come back to you closer to market opening. Need to take a very quick break right now. On the other side, of course, we'll have the pre-opening rates. Also, what is the outlook for the FMCG sector in 2024? Abhinish Roy, Executive Director at Nuvama Institutional Equities, will join in. Welcome back here with us on Bazaar Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Getting the first pre-open trades in, and contrary to what the gift nifty was telling us, when the pre-open is suggesting we might just have a positive start. Let's see if this plays out. Right now, the rates are all over the place when you're getting a big 90-point bounce up on the nifty. If I talk about some of the early movers, then NTPC, Tata Motors, Coal India and BPCL. These are some of the names that are, starting off on the upside. Let's see SBI. The big hallmark of the last week of 2023 was, of course, the continuation of the PSU rally. Let's see if 24 will start off on that note as well. The pre-open seems to be indicating that some of your PSU stocks will probably start out positive. Let's get in a few F&O trades, then strategies that you can look at for the day. We have Chandan Taparia joining in for exactly that. Chandan, good morning. Good to be speaking with you on 1st of January. Happy New Year to you. Tell us, what are the trades that you'll work with today? You're on mute, Chandan.
Good morning, Surbhi.
Good morning.
You can understand the hangover of start of the new year. Thank you so much for having me. Wishing a very happy new year to all the viewers and entire CNBC. May bulls roar and head prosperity in the life. Talking about Nifty, we have seen a decent run-up of more than 20% in 2023. And we believe this momentum could continue in 2024 as well. But looking at the immediate setup, the index is making higher tops, higher bottom, and supports are gradually shifting higher. Rollovers were in line, almost 80% rollover in Nifty, but longs were added as open interest was up by around 20-23% with surge in price by 8 to 9%. So we believe that till Nifty holds about 21,500 zone, this momentum can extend to us 22,000 to 22,222. Talking about Bank Nifty with slightly underperformance in yearly basis, but in this series or in this month, it managed to catch the momentum. So overall, up move could be there until it holds above 47,750. We are expecting Bank Nifty to head to us 48,800 zone. Talking about trading idea, we are positive on the auto name. Most of the auto stocks are in top gear. So here we are recommending to buy on TVS Motor. This stock is continuously making higher top, higher bottom formation from last 9 months. And we believe this momentum could continue. One of the strongest auto name has given a fresh breakout, which could aid further 5 to 8% rally. So one can buy TVS Motor with support of 2,000 and expecting a rally to extend to us 2120 and beyond. Second trading idea, that is the new counter buy on GMR Infra. This stock has formed a pole and flag pattern on the daily chart. It has given a decisive close above 79 zone. We have seen better rollover with short covering activity. Longs are rolling, which also indicate up move. So one can buy GMR Infra with support of 78. And here we are target to us 87. Last trading idea, that is buy on IRCTC. In 2023, CPSE index has really done well. And we believe that most of the CPSE stocks will continue to do well at the beginning of 2024. So positive on the railway, defense, PSU. And here we are recommending to buy on railway counter and buy on IRCTC. This stock has given a consolidation breakout with decisive close above immediate hurdle of 888.90 zone. Positive price setup clearly indicates that rally could extend. So one can buy IRCTC with a stop loss of 875. And here we have a target to us 910 to 920 zone.
Chandan, thank you very much for joining in. New year, let's put the spotlight now on the FMCG space. The Nifty FMCG index ended 2023 with a return of nearly 30%. The big movers were Tata Consumer, 43% higher for the year, ITC up 40%, Nestle giving you a return of 35%. There were two laggards, and they were impacted by the slowdown in rural consumption. Dabur, flat return, in fact, slightly lower, 0.2% lower for the year. And HUL too had a very modest gain of about 4%. But the big theme which drove FMCG returns was easing inflation and higher gross margins. Abneesh Roy, Executive Director at Nuvama Institutional Equities, joins in on the show now. Abneesh, morning. Rima here. Thank you for joining in and Happy New Year to you. What's going to be the big story for 2024 according to you? 2023 was about improvement in gross margins driven by lower inflation, but there was rural stress. If you had to talk about the big three themes for the FMCG sector that will dominate the way the stocks and the fundamentals, what would they be?
Sure, thanks, and Happy New Year to CNBC team and all the viewers. So yes, it was a decent year for the consumer stocks, and a lot of the stocks did quite well. Some of those were back-ended. The FI inflow clearly is helping. You also talked on Dabur, HUL, those were laggards. So we do see that the outlook for the sector will continue to remain decent over the next 1 year. So what we see is 3-4 key trends which are currently a problem. When December results will come out in the next 3 weeks, you will see that the December results are still quite challenging for most companies on the volume growth. Our sense is most of the consumer stocks will see almost flattish volumes, YOY 0, 1%, 2%. The gross margins will continue to improve. So one big trend we see in CY24 is the volume growth, which is very anemic currently. In the second half of the year and even in the first half, we will see recovery there. Companies are taking a lot of action. There is a lot of government subsidies. There is a deflation also which has kicked in. So we see gradual improvement there. And even general trade in the urban India has been a big challenge. So that's one trend which is going to be positive in terms of outlook, gradual. December quarter results will be weak from a volume growth perspective. Second issue for the sector has been local players have been a key issue in detergent, biscuit, tea, etc. This is a thing which is not a long-term theme. We see companies, large companies like HUL, Tata Consumer, etc., take a lot of proactive steps, Godrej Consumer also, against the local players in these categories. So we see that the market share slight loss which has happened to the big players, that will also reverse in CY24 gradually. Also, the pricing this year in CY23 has been quite weak. So we see that also picking up. In most normal years, or if you see long-term trend, consumer stocks take 2 to 3% or 2 to 4% kind of a CAGR in terms of pricing. We see that coming back in the second half. First half still it will be a bit limited. So overall, we remain positive. Our top picks like Colgate, Nestle, ITC, Tata Consumer, etc. have done quite well. And going ahead, we see from next 1 year, Dabur HUL also doing well. So these are not short-term ideas, but we see that because of the reasons that I mentioned and FI inflow also coming back, HUL and Dabur look good from 1 year perspective.
Okay. Got that. Abhi, just a second there. Bajaj Auto sales have come in. They're slightly below the estimates that we were working with. They've done about 3.26 lakh units. We're expecting about 3.5 lakh units. Month on month, obviously, it's a decline. Last month, Bajaj did about 4 lakh units. So month on month, it's a decline. Yeah, you've got the monthly comparison up as well. Year on year, a little lower than expected. We'll be speaking with the management, of course. We'll get more color on those numbers and the trends ahead for the year in a bit from now. But Abneesh, good morning and season's greetings to you. Wish you a very, very happy new year, and maybe may it be positive in every way for you and your family, and of course all your near and dear ones. I just want to go a little deeper in the point that you made, that absolutely I think 2023 is disappointed in the form of the lack of volume growth, and you're saying that will probably show up in the December numbers as well. Now, among all the companies that you cover, which are the ones that perhaps you would expect start surprising positively on the volumes front, the proactive measures that you're saying that some of these companies are doing to counter regional competition, for instance? Because at the end of the day, I mean, volumes have to come in, right? FII's flows will come and maybe that lifts stocks, but that's not a fundamental trigger. Fundamentally, A, which company may start showing some traction on volumes first, and B, I mean, if not volumes, then what else should be the fundamental trigger that could perhaps, drive an interest back in FMCG stocks this year?
Sure, it's a good question. So from a change or recovery perspective, we see United Breweries being a clear beneficiary. When I see even December quarter results, as I said, most of the consumer names will have almost flattish volumes. I think two companies would stand out. One will be United Breweries and second would be Nestle. So these companies will continue to have a good momentum. We see United Breweries delivering almost high single-digit kind of volume growth, which is a good number in the current context. And going ahead, the second theme which will excite investors will be that the pricing for the sector will come back. So if you see CY23, that has been a key disappointment. In fact, you will see in December quarter, Unilever and some of the companies will have a negative pricing. CY24, we expect in second half that will reverse. So these two will definitely excite investors. Third will be clearly in terms of raw material, no big problem. Mostly it's benign, but some companies will benefit in fact. So Tata Consumer in its tea business, HUL also in tea business will see gross margin expansion and milk prices also correcting. So you will see Nestle, you will see Jubilant Foods, etc. Their gross margins will expand in CY24 because of the benign or correction in the raw material in milk.
Okay, by the way, I've got some shots on the screen there. That is ISRO's ExpoSat. Aboard PSLV C58. That's the launch vehicle. And the satellite is the ExpoSat, India's first dedicated polarimetry mission. Apparently, this is, of course, a spacecraft that's going to do a deep scientific study of black holes. So it's cutting-edge science that this mission is all about. That's ISRO in focus, doing India proud as always. Abneesh, just very quickly before we wrap out, can't end an FMCG conversation without ITC, right? 2023 continued to be very charitable for the stock, but the question is at about 450 thereabouts. Are we at the top here? And apart from the demerger of the hotels business, but any other triggers? Would you at all look at ITC this year, or do you think ITC has pretty much had has run its course over the last 24 months?
Sure. We see that ITC is a good long-term compounding story because we have seen that the government policy on taxation has been quite reasonable because the legal industry is getting back market share and ITC is the number one player there. Near-term ITC will not be among our topics because volume growth in December quarter, as I said, even for ITC will be almost flattish because they have a high base in the ITC cigarettes in the last year in same quarter. But because this time the union budget is also delayed because of elections, we'll have the real budget mostly 6 months down the line. That gives ITC a more leeway to get back market share in terms of the illegal. And definitely even in the budget after elections, we feel that the reasonable taxation policy will continue. So no big near-term triggers, but it is a compounding machine. So you will see that the hotel demerger also adds to it. But from a near-term perspective, our top picks will be United Breweries, Nestle, Tata Consumer, and Godrej Consumer. These will be our top picks.
Thank you. Thank you, Abneesh, for your insights into the new year for the FMCG sector. Wish you a good one. Let's now go across to Nimesh for the standout brokerage report of the day. Nimesh.
Hi, Rima. So today's standout is an IndiaMart. Technically a double downgrade. So BofA is to downgrade the stock to underperform from buy, and they've sharply cut the target price to 2,500 versus 3,600 earlier. So technically a 10% downside even from current levels. Now, the key reasons for the downgrade. The first one, slow net additions. For quarter 3, they expect net additions of just 2,000, similar to quarter 2, which is much lower than the company's initial target of 7,000 to 8,000 net additions per quarter, as well as their medium-term target of 5,000. So that's going to be disappointing. Second, downside risk to the consensus earnings. Now, the stock is already trading at close to 56 times on FY24 price to earnings and 44 times on FY25, and they find it expensive in the context of competition coming in from other players. So that's the second reason. The third reason is medium-term competition risk. While they believe that the B2B market is quite large, they note that 50% of the users contribute 75% of the revenues, and all the competition is going to target the same customers. So there could be multiple compressions going forward. So on back of all this, they've cut the EPS estimates and consensus earnings by 2 to 10% for FY24 to FY26. So a double downgrade in IndiaMart to an underperform now, and target price cut to 2,500 versus 3,600 earlier.
Okay, all right, Nimesh, thanks a lot for that. Well, just quickly, I'm going to run you through what Motilal Oswal has to say on Dalmia Bharat. They say it's a top pick from the cement pack for 2024. Hence, they have a buy rating. Their target price is 2,800 rupees. They say, yes, in the last 6 months, Dalmia has underperformed both the Nifty as well as other cement stocks. But valuation-wise, they say it's trading at less than 10 times on an EV upon EBITDA basis. And they believe there's scope for it to re-rate because earnings will improve from here on. And the capacity addition focus as well is something that they like. Remember, Dalmia has said that they're going to be heading towards 110 to 130 million tons in the next few years. And the sustainable growth will be backed by initiatives like blended steel, green energy mix as well. The strong balance sheet will help them in good stead. And the EBITDA estimates that they're putting out as well is something that Motilal Oswal has spoken about. But unlike what the gift Nifty was suggesting, the Nifty is now opened up with just a 5-point cut, I think. So it's down only around 10 points as we speak. And a few stocks that are really moving in pre-open, I think BHL, that's a standout one. That's up close to around 4%. So massive volumes we're seeing out there. You have Oracle Financial as well. That's up close to around 2.5%. So those are the two big movers. On the Nifty itself, well, we're down now close to around 25 points. Or BPCL, that's up 1%. Coal India is up 0.7%. Mahindra & Mahindra is down close to around 0.7%. And Bajaj Auto, the exports looked a little bit weakish. We'll try to get more clarity on that. But for starters, that's down close to around 0.5% or thereabouts. And let's pull up Escorts. I think I even saw those numbers that were flashed on the screen. They looked a little bit subdued on a year-on-year basis. Escorts mildly in the red. But guys, I think most of the street is out still on party mode. So we'll have to wait for the next few days to see more participation coming in. For starters, a little on the back foot.
Well, there are no triggers, right? At least global triggers, with most of the global markets shut today. Let's run you through some of the big movers on the large cap front. So BPCL is now the top gainer. That's up close to about 1%. Oil prices continue to remain on the back foot, benign, $77 per barrel on crude. So BPCL has opened with strength. Coal India has been one of the big movers of 2023, and it continues its run on day one. In pharma names, you've got Dr. Reddy's, Divi's Laboratory holding up smartly, Cipla, Apollo Hospital seeing buy. That's up close to about 0.5%. On the losing side, Bharti Airtel sees a bit of a correction in terms of frontline large cap banks. It's Axis Bank, ICICI Bank, subdued in trade. Eicher Motors is down 0.5%. Bajaj Auto, where the overall sales numbers are lower than what the Nomura expectations were. The company has reported a 16% jump in their total sales year-on-year at 3.26 lakh units, but this is lower than the 3.5 lakh units that the Nomura poll indicated. So Bajaj Auto, a bit of a disappointment. HDFC Bank too is correcting now in the red, down 0.5%. HUL weak, and few of the IT names are trading flat. Infi and TCS just down 27%. Quiet as it gets.
Quiet, but midcap's already getting excited. Of course, volumes are thin, so you have to take that caveat on board. Check out RailTel. The stock had a great week last time around, and it's building on those gains right now. We spoke with the management as well. They're talking about a sizable opportunity going ahead on the signaling side. So RailTel is off to the races. Look at that, 6-7% building as we speak. Jyoti Laboratory is a very positive start for this one, 4% up here. Interglobe Aviation, there's a cut in ATF prices, which works well. And obviously, we know how airports are overflowing and the demand is as strong as it could be. So good start for Interglobe as well. Checking out some more stocks and news. Dhampur Sugar is positive. 3rd January, they're doing a board meeting for a buyback. So Dhampur is up about 5.5%. BHL, Nigel mentioned, still retaining those gains of about 3.5-4%. So these are the ones. Zomato, of course, record orders, but the stock's been running. I mean, a lot of it is getting priced in. A lot of this optimism on improving business dynamics is responsible for the move to 124. So a little quiet this morning, but nonetheless, up and about. Let's see what else is coming up. Godrej Industries has had a good couple of sessions. That continues today. JBM Auto, 6.5% up as we start off. Zensar is up about 2.5%. GETND, a stock that we don't talk about too much, not the most liquid, but anyway, it's up about 5% this morning as well as we start things off. So not too bad. We're looking at more traction coming in. By the way, the PSUs are still at their game. We mentioned BHEL. Look at the others, SJVN, Coal India, NALCO, IOC. So quite a bit of this PSU party is also well and truly underway. Speaking of party, let's welcome in our next guest on the show, Samir Arora, founder and fund manager at Helios Capital. Samir, thank you for joining in. Good morning to you and wish you a very, very happy new year. May it be fabulous, positive, healthy, wealthy in every way. So you tell us.
Thank you very much. We'll take all of this.
Wonderful. Tell us, so will the party continue in 2024?
Well, the party in 2023 was so big that I don't know what people were celebrating last night. They should have been celebrating continuation of 23 forever.
True.
So generally what happens is that when you go in with such excitement, normally the party is a little less than you expect. That is my only worry. But otherwise, at least it should be sufficient to hang around, but it can't be as big as 2023, I think.
Why do you say that, Samir? What makes you a little more circumspect and grounded?
No, I'm not circumspect because I have always said that to be in the market, to justify being in the market, all you need is to be able to say that, can I make 15% type returns? Anything more we take with pleasure, but we can't believe that, stocks should be up 50%, 100%, stocks which are well known, where earnings growth are in the 10, 15% to make 100% earnings, price growth is a bit too much. So just from that angle, but I am fully invested, high net, because I am not expecting or thinking that you need 25% to be in that position. If you think that broadly equities will do better than other things and that they'll do in absolute enough to be in the 15% type range, that's enough. Anything more you take, but then you have to believe that you are somewhat borrowing that from the future.
If Samir reminds me of the emphasis of yesteryears. You keep your expectations modest, and then if life goes out and surprises you, then it just feels better, right?
Yeah, I like the way Samir put it. Sometimes expecting the party to be blockbuster, and then sometimes it falls short of expectations. That's an interesting way of putting it. But Samir, good morning and wishing you personally and professionally a very, very good showing in 2024. But last year, if you had to pick up a couple of themes that did do well, the PSU themes, they did very, very well. For 2024, if you have to say that this could be the sector, this could be the space that will do well, what would you pick?
So actually what happens is that normally for the first few months, the same momentum can continue, whatever is happening. But you've seen any time, you see 99, although we say it peaked in 99, it went and peaked. The tech sector peaked in maybe March of 2000. Similarly, infra sector, although it was actually infra and all really came to a sudden stop at the end of 2007. But generally, you would expect without any big events that the same thing continues for 2-3 months. And then some things happen, some things change. Maybe when the new government comes in, you feel that too much expectations are already in. And even if they do the things that you want or think they will do on PSUs, like it happened in 2014, the PSUs in the second half didn't do well. Actually, if you look at 2019, where the win of the BJP was quite big, actually the market didn't do too much. It finally did well only when the tax rates were cut in, I think, September of 19. So all I'm saying is don't expect the same, but broadly our model has been that all the time some 1/3 of the market is doing very well and you don't exactly know which one. But if you buy 30, 35, 40 companies, you cover every angle that you can, and then you gain some and you lose some. But in the end, gain more than the market. Yes. Hi.
Morning. This is Rima here. In your flexi cap fund, you also have some new age tech companies. I think you're betting on Zomato and Paytm. Now, Zomato has done exceedingly well. Last year the stock doubled. But on Paytm, towards the end of the year, there were some regulatory clampdowns, which is hurting their business. How would you approach Paytm, and would you look to widen your investments in these new age tech companies beyond these two stocks?
So first thing is, I'm not the fund manager of the mutual fund, but Paytm is a I also own in the offshore fund, so I can say that the market was a bit harsh and this thing won't work so much to be so harsh, because basically if a company on its own wants to cut down on something, obviously based on the environment, and saying that I don't want to do this anymore because the environment is saying but we are not doing badly in our own actual lending to that portfolio. I believe they have said in various forums after that they'll be able to demonstrate that it was not their own portfolio that was doing badly. Second thing is, if you look at the market cap of Paytm, I think it's 32, I forget, but I think it's some 30,000 crore, which is like $4 billion. And this has become like Xerox or like other things, which has become, a word for doing payments by phone. Which other business, new age business, is at $4 and $5 billion? You look at even Nykaa is at some 7-8 billion, and all those, which have not become as one-to-one with the business of their industry. And I think so. Paytm, I think, is good. We have added a little bit here and there, maybe 25 basis points, then another 25 across different funds. I like it a lot.
Okay. Samir, let's talk financials, because I think one consensus trade that everyone seems to be going with is that quickly load up on private sector banks because they haven't run and FIs will come in and then we know what happens. A, do you believe in that trade? And B, beyond the large cap banks, what else are you expecting from financials this year? I mean, NBFCs have had a bit of a rough ride, a lot of regulatory changes there as well. Would you look at something else? Would you look at insurance, asset management? What beyond large cap banks in 24?
So asset management, we believe enough to have started our own asset management company and put in maybe 100 crores in it. And that also personal. So that is clear. But, the trade of the big banks, I think, is the easiest. Now, if it doesn't work, I don't know, that'd be very disappointing. But the real thing is that if there are three big themes in India, which is IT, consumer, and financials, from every angle, relative and absolute performance and the stock price performance, the financials is the easiest trade. What would you rather buy? A company which says that my earnings are growing 15-20%, but the stock price is flat, or companies in IT sector where they say that we are growing 0, but there might be a recovery and we might grow at 10% next year, and the stock prices are up 30-40%. If you look at the IT sector from 2019 March to now, so you look at the earnings and you look at the cumulative earning growth from 2019 March to say 2024 March, these guys have grown 60%, 70% cumulatively in earnings. And some of them have grown 100%, and the stock prices are up 3.5 times, 2.5 times, basically much more. And again, next year, the earnings growth best expectation is 10-12%. The financial guys have been always growing at that rate. And you get them at prices which are 2-3 year old, and they're a big part of the market. So I think that the foreigner, if he comes, and that is the key part of the story, whether he underweights, overweights, he has to buy 25%, 28%, 30% in financials, which is, if they're putting in 20-30 billion, which is what minimum we would expect, that means they have to put $5-6 billion into these stocks. And so they should outperform. Now, if they don't, we'll see. But we also totally agree. Actually, I've been one of the earliest ones in this for 1 year saying that FIs will come and buy, but they haven't come, or they have bought in the last few months, but not before. I think it's the easiest trade.
And Samir, HDFC Bank, towards the last quarter, we kept asking you, Samir, what's happening on HDFC Bank? You said it's one of your top holdings. And towards the last quarter,
number one top holding.
It came to the party. Number one top holding, that's the one that you
not
told
one of the top holdings. One of the top is different.
It is the top holding. Is the top holding. So you believe 2024 will be much better? I mean, fundamentally, yes, things are looking good. But
so, I don't like this idea that many people say, oh, when you buy a stock, it should be so painful. If it's painful, you'll make more money. It's absolute nonsensical thing that these people do. Not you. I'm saying people say that the stock should look that it's very tough and then it should do well. No, sometimes it should just be an obvious stock and you buy it. I made so much money just buying the obvious things in life. And it looks to me one of the more obvious ones to do well. It doesn't have to go up 40%, but it has to go up 20%, 25% for a few years. Then I will be happy. But previously, it has done that really for all my working life. So I don't think.
So Samir, just to complete the point on financial, we get what you're saying. I think no gain without pain. I think that's something that holds true in the gym. Maybe in the stock market, you can just keep getting gains without the pain, and that's fine, right?
We have suffered the pain for 2 years.
That's also true. You waited.
Didn't do well. Yeah.
Yes, you waited patiently.
But just to say that now it's obvious, it doesn't matter if it is obvious. I think it's obvious and good. And just before I came in, your person said, are there any disclaimers? So I hope the disclaimer is obvious that we own the stock across every point.
No, we'll put the disclaimers out, but just to complete the point. It's the obvious disclaimer. Just to complete the point on financials. So, okay, this is the obvious part. Large banks, which you already own. Give us your sense on anything else. When would you stay away from NBFCs? And what about insurance? Insurance has had such a volatile 2023. The stocks move up and down with every regulatory change. Now there's some talk that, the surrender charges will go up and then the stocks fall and then some tax change will happen. So what do you do with insurance?
So I don't own it in the mutual fund. They own SBI Life. I don't own any insurance company. I like obvious trades. I'm a lazier guy than all these guys. But we own NBFCs. Even Paytm is an NBFC. We own smaller banks also. And we own a few NBFCs. So broadly, we like the sector simply because the earnings growth is easiest to see. The quality assets, the quality of lending is easy to see. And although at the margin, somebody might say that, there has been too much hype in small loans and all, it still is small only in total absolute quantity. And I think we can maneuver through that and these companies can go through that somewhat more easier than other places where the macro is not working in the sense. I don't think IT guys will in any way please the markets in terms of their guidance or their results. And the consumer mostly will be disappointing if it is not catering to the upper end. So the real growth is going to come in financials of all kind.
Samir, any other obvious trades apart from HDFC Bank? And you spoke about Paytm. Anything else that you would be comfortable with?
No, Paytm I'm not saying is obvious.
Paytm I'm not saying is obvious. HDFC Bank is an obvious trade. Is there any other
ICICI and HDFC
trade?
Bank are obvious. The other obvious trades might be on the other side that, many stocks that are up primarily because the markets are up. Even though, by the way, my mutual fund may be owning them, I don't know. But broadly speaking, I think that somebody, whether it's SEBI or it is the stock exchange or it's the government, will put some complications on these futures and options trading and all these things because it is just too blatant. It is too obvious because here what happens is that if the market comes down, say, 20 days before elections for unrelated reasons, it just leaves a bad this thing in the market. And main thing is that if something is very obvious, then the system comes hard on everybody, including on the regulators, on the exchanges, saying, didn't you see that in the world, the ratio of futures to cash market is, say, they say 4:1 or something. And here we have 501. What did you want? Did you want 1,000:1 before you would come in or something like that? So I think the conversation is already started, if you see, just in the papers and all, that it is a bit too much. And this amount of punting by everybody is not healthy for anybody. Everybody thinks that they are going to be financially independent. So sorry to break your heart, but this cannot get you financial independence like this. So this It will be done just because the systems work like that, where you have to protect the overall sanctity of the market, and the speculation cannot be so in your face. I think it is too much in our face.
Samir, just a quick 30-second answer before we wrap, and we'll be, we have a next management also waiting. But just wanted to ask you this: in your circles, in the chatter, when you go around the parties and just the chit-chat, on this absolutely breathtaking PSU run, are there still believers out there, or are people saying let's lighten position? But just what's the approach, given what we've seen in 23 on PSUs?
Over the year, we have also bought 5-6 PSUs. We had only, say, 2.5 before. Yeah. I always had State Bank and Bharat Electronics. And then then we bought HPCL, then we bought another bank, then we bought IRCTC. There at least you started from very low valuation, and even now somebody can justify it. But again, look at the QIPs of these banks. At the last minute, that QIP size went up. I forget how much it was, some 4,000 crore QIP. And in the end, some 80,000 crores of orders were there. This is totally wild. It actually, because I've seen this for too long, makes me feel that don't call it too much interest, too much money waiting to be in the market. You have to just call it too much speculation. And too much speculation doesn't work. So from that angle, but not against PSU, this is against the market in general. PSU, somebody can still justify saying, they had not done well for so many years, so now they have done well. And even I'm saying that for some of the stocks that I own, that these are the only way to play these themes. If you want to play the fact that there is a big investment in railways, who wants to buy these capital-intensive L1 type of which guy will get what order by the guy delivering food to all these trains and go on and booking tickets and move on. So that all depends. I don't think PSU per se people are saying is too wild or too speculative, but overall market, everybody's.
Samir, great conversation. Thank you very much for joining in, and look forward to many such delightful conversations in 2024. Well, let's get to Bajaj Auto. They just reported their December auto sales. The company has reported a 16% jump in its total sales in the month of January at 3.26 lakh units. But this is slightly lower than the Nomura estimate, which was 3.5 lakh units. To break up that 16% growth that we've seen in January, domestic sales have gone up 28%, while exports have seen a growth of only 2%. Rakesh Sharma, the Executive Director at Bajaj Auto, is with us on the show. Rakesh, Rima here, morning, and wish you a very happy new year to you, your family, and everyone at Bajaj Auto. Just provide some more color on the January sales. We've got the numbers with us, but how did premium do, mass market, what is the retail uptick looking like, and then the guidance and the outlook for the month of January?
Good morning and very happy new year to all of you too. December was a great month. Usually, December following on the heels of the festive period of October, November sees a big drop. We did not see that big a drop, and it was in line with our strategy, which has been to, as I've been saying, which has been to focus on the top half of the industry. And I think over there, even in December, we outpaced the industry in domestic motorcycles by almost 2 times. So giving a further expansion of market share in that very strategic 125cc plus segments. The newer businesses like Chetak did well. We continued to garner market share, and supply chain kept expanding its performance. So we breached the 10,000 mark from a registration point of view in December as well. So that was very good. There was no sort of fall off in the Triumph sales, which also again augurs well for the coming months and quarters. So December retails were almost entirely equal to the festive period, November period sales. The three-wheeler business, keeps marching on with its market share at 80%, expanding the CNG and growing the electric three-wheeler component in the business also. Exports, a marginal improvement in the quarter over the quarter 2. So we are hoping that the macroeconomics and the geopolitics starts to turn positive in the coming quarters, we are well positioned to harness any improvement over there. But for the moment, it's a watch out. I mean, we are still watching the export front.
All right. Good morning, Mr. Sharma, and good to see you in. Wishing you the best for 2024. Nigel on this side. Well, I want to ask you about the exports. I understand your various parts, brokerages, they were wondering whether or not there was some container issue which was impacting exports. It could be temporary in nature, but is that true?
Yeah, good morning, Nigel. Happy New Year. You're right, because of the little fracas in the Red Sea, we did face some disruption, and the shipping companies have been quick to increase the freight rates a bit. But you're also right in observing that it is not going to last, but for the moment, yes, shipments were delayed to some parts of Latin America and Africa.
Okay, all right. And also with regard to exports, as you said, it's an improving trend. Of quarter 3 will be better than quarter 2, and quarter 2 is better than quarter 1. You expect the improvement to continue? If you could give me clarity on that, point number 1. And point number 2, since you're outpacing the market, what is the updated market share in both the categories, the 125cc plus as well as the domestic market?
So certainly we expect quarter 4 to be better than quarter 3 in exports. But, the caveat is always the volatility in the currency market, which seems to be easing up to some extent. But then you also saw things like the major devaluation in Argentina, which is an important market to us, for us. And Nigeria also still a little bit restive over there. So, however, like you said, the trend is the things are calming down. Now, what's the rate at which things return to normalcy is something which we can only wait and watch. But I expect quarter 4 certainly to be better, marginally better than quarter 3. In the
domestic market share you're giving us,
So the second question which you asked, our market share from a retail registration point of view in domestic motorcycles in the top half of the industry is now running at 31-32%. So it's very, very close to leadership. I don't have the exact numbers as to what happened in the last couple of days, but that's the region in which we are operating, and we are, of course, looking at a number 1 spot in the months to come. We're well positioned with the entire Pulsar range now almost refreshed, and a few more launches going to hit the market rapidly between now and April, every month almost. So there will be a lot of activity, and I think that should provide us a good boost to wrest leadership of that segment.
Just getting back to the point about exports, and did you lose any? Was there a loss of sales on account of the Red Sea disruptions? You all did exports of 1.35 lakh units in December. Would that number have been higher if it weren't for this disruption?
No, not really. There was no loss. There are some delays, but there are channel stocks. So as yet, the disruption has not affected us materially.
And what's been the total Triumph sales so far for you now since its launch, and what are the bookings looking like for the future?
Well, the retail number is about 2,500 units. We are running at that rate, which is what the number for November was also. And this is, in the 45 odd stores, which have been sort of newly launched. So it's not an all India number. And quite significantly, some of the areas we are already starting to see market share of 15 to 20% levels. Again, from a Vahan registration point of view, in important markets like Kerala, we're not there across Kerala, but Trivandrum, Cochin, we are striking above 15%. Bangalore, certainly above 15%. So wherever the store footprint has expanded and people have had the time, like say 2-3 months to sort start talking about the brand and activate things locally, we are seeing a very good movement in our market share. We will continue to expand, and we are hoping to close the next quarter by almost doubling the store network which is there today, and that should sort of boost our retails quite a bit.
Mr. Sharma, finally, just to end with, let's get a big picture sort of projection for you. We are speaking on the 1st of January. I think for the calendar year that's closed out, I mean, total sales were up about 7% with some recovery in exports. At this point in time, do you have some rough projections that perhaps we could work with? The new normalized run rate for exports, I mean, will it continue to be in this vicinity of 135,000? And also just give us a sort of a crystal ball look ahead. 2024, is it going to be more about rising volumes? What about competition? What about just the way you think pricing trends will play out, particularly in the premium end, which is where, of course, Bajaj has a lot of dominance?
Well, I can say that, as we enter 2024, I must say it is, after quite a while, very promising from where we are standing, both from an industry point of view. Our class of customer seems to have returned. There is certain optimism, and there is a little bit better purchasing power. So the economic recovery is finally reaching our class of customers. We are very well positioned in terms of, I just spoke, a refreshed new range, a very throbbing pipeline of products which are going to hit the market. And what happens is, whenever there is optimism in the market, and with that backdrop, new product introductions always get you a lot of mileage. So to that extent, the ducks are pretty aligned as we see it for the forthcoming months. The newer businesses like Triumph and Chetak, which we really started to get our sort of supply chain and our front end in position, they've got validated, accepted, and we are now looking at a period of scale up now. So we are from, getting our act right and getting the basic apparatus right. We are now moving into a phase of scaling up these newer businesses in 2024. The exports recovery, like I said, is really, there is not much we can do, and we don't want to sort of do things which will counter macroeconomics. I think, we have steadfastly kept to our pricing and margin profile because we don't want to use that bit to counter exchange rate volatility. So from a mix and from a margin point of view, the export business is extremely well positioned. It's just that the volumes now completely depend on the recovery of some of these key markets, which a few green shoots are there. So when you and on the other side, at this point of time, we are not seeing a huge pressure we're not seeing a pressure from the cost side. So when you put all these things together, it does look promising. Yes. My fingers are crossed. There shouldn't be any geopolitical or macroeconomic disruption. We should navigate the election period properly. Sure. And it looks like a good time for the industry.
Thank you, Rakesh, for joining in. All the very best for 2024. Get into a break. On the other side, we'll be joined by Gangadi Madhukar Reddy, MD and CEO of MedPlus Health Services, to discuss the recent drug license suspensions. And we'll also connect with Govind Singh, MD CEO at Utkarsh Small Finance Bank, after RBI asked lenders to curtail credit deposit ratio to 75%. Stay tuned.
Welcome back. Here with us on Corporate Radar. MedPlus Health Services is the next company on our radar. Now, this company has received several orders for drug license suspensions across various states. To talk about the impact of this on the business and, of course, the outlook going ahead, we have with us Ganga D. Madhukar Reddy, Managing Director and Chief Executive Officer at MedPlus Health Services. So thanks for joining in. Good morning to you. Season's greetings. And first of all, wish you a very, very happy new year. We just want to start by understanding... Thank you so much. We just want to start by understanding the nature of these orders. You know, December 20, order received for suspension for a drug license in Telangana for 5 days. On December 22, there's a suspension in Karnataka, Tamil Nadu, Andhra. Why so many drug suspension orders? And what's the impact that this is likely to have on the business?
Sure. So we have over 4,200 stores. And in all these stores, we have got pharmacists who are working day in and day out. There are times when, you could have a drug inspector walk in and maybe not have all the regulations or all the paperwork in order or something like that. And for that reason, you end up, sometimes getting a suspension for a few days. For us, it is not material. And that's the reason why we did not actually report it in the past. These things have been happening for a while. It is only now that the SEBI has actually said that irrespective of the materiality, you actually have to report all these things, and hence we're doing it. But for us though, in a year, if we basically shut down maybe even 30, 40 or 50 shops for 4 or 5 days, that's less than one store shutting down out of the overall 4,200 stores. So not really material, I must say. Not that we are happy with the way it is, we're trying to improve it, and we're trying to, make sure that we are in line with all the drug rules, but definitely not material.
No, exactly. I was just coming to that. I understand you're saying it's not material, but when you add up all the daily shutdowns, is it what? I'm guessing 1% of sales, maybe less. Can you give us the quantum? And also, then there's a sentiment issue here. With the disclosures now coming in, investors will want to know why this is happening, and more importantly, how do you mitigate this? How do you ensure that whatever these disruptions are because of paperwork, as you said, how do you ensure it doesn't happen?
We are actually putting in better IT systems and all to take care of a lot of these things out there in the store. And I wouldn't say we have to live with some of these things, but this is the nature of the business. But better control, better IT systems. That's all there is to it. We are working on it. And as I said, even if you add up all the things, it doesn't even come to one store shut down for one full year. And that's out of 4,000 stores. So it is way less.
So while it's not unusual and it's happened in the past, has there been at least an uptick in the suspensions or no?
No. These things happen. No, I really will have to go and look at all the numbers to see if there's uptick, but it happens from time to time between different states. I don't think there's a major uptick.
Okay. So how is business then on the diagnostic front? How many locations are you operational in right now? And do you have a target for 2024 by the end of next year?
Diagnostics, as I have mentioned in the past, is still in the pilot stage. We're there only in one city. It's a subscription model. The plan is to basically sell insurance-like subscriptions to the entire city, which means you need a network covering the city fully. And that's why, whatever money we invested it only in one city. So we'll probably continue to be that till we get really comfortable with the number of subscriptions and all, until we get comfortable about the overall acceptance of the plan itself. So for now, no immediate plans to move out of Hyderabad. If that answers your question.
Okay, all right. Hi, sir. Good morning and good to see you. And, you had also entered that generics med segment. And out there, you were looking at gaining some market share, but there was some discounting as well. So give us a couple of aspects then. How is offtake and what is the current discounting trends out here?
Based on volume alone, the uptake has been fantastic. We started in Telangana nearly 4 or 5 months ago. We started end of June. And these numbers are out there in the public domain anyway. We were at around 2.42 crores per day in Telangana when we started it. By the end of September, we basically reached 2.83 crores. So massive uptick, I would say. We have products available for roughly around 55% of all the medicinal needs. So what that means is, exactly what that means actually. And we have seen an uptick of almost a third of that. So 18% of all medicines today sold in Telangana region or from the MedPlus brand. Uptake is great. Now, as I said, it is volume growth. Obviously, if I am selling a drug which I would otherwise sell at, let's say, 100 rupee MRP drug, our usual discount was 17%. We'd have sold it at 83. Instead, today we're selling it at 40. Obviously, the top line is going to be slightly lower. The margins are not affected though. On the same 100 rupee MRP drug, we actually make slightly more than what we would make on the branded generic. But the volumes have gone up significantly.
Mr. Reddy, give us the store rollout plan as well, and also the geographical sort of focus that you'll have. I know that you've been opening beyond the southern states. There's a MedPlus store near my house here in Mumbai now. So what's the total store rollout plan for FY24, and also just a sense of how revenues might move, given what you described, given that there's the generics play coming in and a lot of this discounting, but you're saying that margins will be up. So what does that translate into revenue growth projections for this year, 24?
I think they're still going to be in line with what we had actually earlier said. I don't think there's going to be any major difference out there over last year. But what I would really like to focus on is this. While store growth is has always been there, will continue to grow out there. That's not what we are really looking at right now. Think of it this way. In India, 80% of everything we actually sell is all generics. These all have been off patent for several years now, some of them for decades. We didn't have a large enough store which had its own store brand to actually make it and sell it. So what we sell from MedPlus is on par with any of the top guys out there. In a lot of cases, it could even be better, but it's definitely not inferior. We don't have any of the marketing costs and all, and hence we are able to give this massive discount. We're seeing a fantastic, uptake out here. We think now, for the first time, with the way the Prime Minister's Jan Aushadhi program is going, and the overall awareness being created around the generic products and all, and the fact that MedPlus is now, now has the scale to actually buy and basically get the drugs made and sell them in our own stores, and thereby disintermediating some of the companies out there. I think the industry itself is going to change significantly. I think that's going to be the story this year. Whether we add, 500 stores or 1,000 stores, I don't think it's going to be so.
No, that's a very valid point, and we'll definitely keep an eye out on that. So, while we talk about that growing generic story with some of the government partnership programs, I just want to go back to the revenue picture of the first half of this year. You've done about 2,700 crores. How are you likely to close out the year?
It'll be slightly better. Second half will be slightly better. That's all I can tell you. Yeah.
Okay, all right.
Even your margins have improved in the first half of the year to 6%. What's the outlook on margins?
Again, marginally better, I would say, mainly because a lot of our stuff is now private label. And so the margins are going to be slightly better. It is not as, the current set of private label which we have is obviously not as profitable because we're giving 40 to 60% discount out there on all these drugs. But overall, since these are actually displacing the branded generics on which we make far less, we would actually make slightly better margins as we go forward.
All right, Mr. Reddy, what about the big investor in there, Lavender Rose, which is Warburg, I think.
Yeah.
What is their plans with regard to their holding? Do you think in 2024, at some point of time, majority of this holding will be sold, or have they indicated they want to hold it for a longer term?
I see no reason to, really believe that they want to, at least my conversations with them have not led to any conclusion on that part. But as a private equity company, I mean, they will want to get out of the public market sooner or later. They also hold a significant chunk right now, along with Premji Invest. So between both, they hold roughly around 20%. So I see that they will take every opportunity to sell down a little bit. I don't think they're going to be selling down everything in one shot for sure. So maybe, yeah, in the course of the year, they could sell a little bit.
Okay, all right. And also, I think you're taking approval, right, to go ahead and raise some money. Could you tell us what is the plan out there? Will we hear about a fundraise in the coming quarter or so? If yes, what could the quantum be?
See, it's an enabling resolution. We wanted to basically put it in place to take advantage of the market and all. But the company itself, I'm not really sure if you really need the money right now. Till I decide to really expand on the diagnostic side, we are funded by internal accruals. We don't have any debt. So any growth plan which we have can easily be funded. I don't think we'll, So till that happens, we're not really going to
So as of now, it's just an enabling resolution. You're not expecting to go ahead and raise these funds, right?
Okay.
Okay, and that includes the expansion on private labels, on the generics, the big plans that you spoke of. You said that will be the story of 2024-25. So all of that funding will be internal accruals. Is that right?
We have no debt at all today. So if you really want to get some, working capital loan, we can go and pick it up easily. I don't think that's really going to come in the way.
Okay. All right, Mr. Reddy, we will leave it on that note. Thank you very much for joining in, and good luck to you for the new year that is upon us now. With that, thank you. Let's move on now. Last week, colleague Abhishek reported that RBI has likely asked some banks to reduce the credit deposit ratio to below 75%. RBI did respond to CNBC-TV18's query, confirming that it has asked some banks to lower the CD ratio. To assess the impact of this development, Govind Singh, Managing Director and Chief Executive Officer at Utkarsh Small Finance Bank, is with us now. Mr. Singh, thank you very much for joining in, and season's greetings to you. Wish you a very, very happy new year. Hope it's a very positive year for you, all your stakeholders, and of course, personally as well. Your first thoughts on the lowering of this CD ratio. I mean, have you heard from the RBI at all, and what do you make of this?
Yeah, thank you, and happy new year to you and your team also. So normally, if you look from the control angle, RBI always expects that CD should be in the range of 75 to 80%. And, when we started the bank, and that is true for all the new, you can say converted banks who are earlier NBFC, they become bank. It takes a little longer time for them to reach a certain CD ratio. So normally, the regulator looks at 75 to 80%. And certainly they will ask, banks to go towards that, that trajectory. But normally they will be also understanding that it will take around 5-7 years time to reach that level. So for established banks, for sure, they are in that range. For newer banks, it will take some time. So generally, they will be expecting us to below 100% right now. And that is true for, new banks, whether it is SFB space or even the new universal bank. And that's the trend, and that will continue to be there.
Mr. Singh, morning. So what is your current CD ratio, credit to deposit ratio?
So I'm, it's very difficult to give numbers here. You are aware of,
or a range?
Because from today onward it's difficult. But the only one thing I can say, if you look at our Q2 numbers, so it was close to 100%, and it has come down significantly year-on-year basis. And the trajectory continues. In fact, it is coming down on a continuous basis. Our reliance on deposits is more and more on for our advances. In fact, if you look at our quarter two numbers, also we are a net lender. We are always a net lender in money market. Also, there was no money market exposure, and our borrowings per se have come down during this financial year till H1.
Okay.
So the trend is in that direction.
And how many years, sir, will it take for you, in your assessment, to come down to 75-80%?
So normally, as I mentioned, what has been happening, and the way we expect, because you grow and you build your franchise also. My sense is it should take for banks maybe around another 4 to 5 years to reach around 80% or so. And there will be a gradual decrease on a quarter-on-quarter basis.
All right, Mr. Singh, let's talk about a couple of numbers. I recall, in most of your interactions that you have been maintaining that the second half of the year, the NIMs will improve as fresh disbursements will be happening at fresh rates. Do you hold on to that for the second half of the year? What kind of improvement can we see in NIMs? And also, I think you were guiding for a growth of close to AUM growth of around 30%. Does that hold out?
Yeah, so both the things, improvement in NIM maybe around 15-20 basis minimum will certainly happen in H2, as we had guided in while having an earning call for H1, quarter two rather. And similarly, our growth of around 30% plus for this financial year, that also holds good, the way we have guided in the end of September.
All right, give us some more clarity on the AUM breakup. The micro banking AUM, I think it used to account for around 85 to 88% of your total business. That's come down, I think, to the mid-60s. Where is that number headed in the coming years?
True. So, as I mentioned, at the end of September end, it was around 62%. And we do expect this will further come down. And our, you can say, guidance is around, it will reach around 50% or so in next 3 years' time. And that again holds good today also. So maybe, you can say around 1.5% decrease on a quarter-on-quarter basis, that will certainly happen. So around 4 to 5% decrease on a on an annual basis in the micro banking book.
All right. On the credit cost side, I think you have a board mandated floating provision. So if you could tell us what is the credit cost likely to look like and how much of that, will you be accounting for because of this board mandate that you'll have?
So board has mandated that, 1.5% of our micro banking, the microfinance book, we should create floating provision by March 24. So that we are creating on a month-on-month basis. So whatever our profitability numbers are there, whatever you see till September, and going forward also the way board has mandated and the way we have told investors also in our earning call, that will continue. So at the end of March 24, it will be close to 1.5% of our microfinance book in March 23, and that we intend to continue, because that gives a, you can say, shock observer whenever there are decline or for any natural calamities also, we can always handle those things. So that will continue to be there. Our credit cost for quarter 2 was 2.3%, and we are yet to get the numbers, but we do expect that there will be improvement on overall you can say credit cost for the year when you look for the March 24. And I just want to mention this 2.3 includes the additional floating provision, which actually adds to almost 0.3 to 0.4% for the credit cost.
And it will improve from here, is what you're saying. So you end the year closer to 2%?
Difficult to say today. As I mentioned, it's very difficult to give any number today. But we are certainly expecting, as I mentioned in the earning call also, certainly expecting further improvements there.
Okay, all right. So we'll leave it on that note. Thank you very much for joining in. Good speaking with you today. That's Utkarsh. Thank you very much. By the way, the market's very quiet on the frontline indices. It's all about individual mid-caps. Mid-cap index is flying away, up almost 0.6% and lots of movers and shakers. I'll just throw some more names in, just to keep the screen buzzing. Look at Yes Bank, about 7% up. Railtel is up about 9% right now. Talk about more movers and shakers. You've got something like LIC Housing Finance, IRIDA, the recent PSU listing, IREDA, that's up and about. JBM Auto now 13%. That's the kind of gain it's clocking. Jyoti Laboratories, Olectra Green Tech, 4-5% up here. Very, very lively mid-cap screen. Though, of course, you can argue that volumes are thin, but then 1st of January, so we can't expect any more. Take a break on that note. We'll come back on the other side and find out what commodities are doing. The few markets that are open, what are the cues that we are getting in. We'll have Manisha joining in with the latest. Welcome back. As promised, we'll talk about the commodity market action now. Manisha Gupta is with us in the studios. Manisha, Happy New Year to you, first of all. Are there any commodity markets, global markets trading, or no? It's just like us in the equity space.
Well,
we're the Lone Ranger.
Not rub salt there. Well, yes, the volumes are really low internationally as well. Most of the international markets, the big exchanges where they are situated, those markets are also shut. So we're looking at lower volumes right now. But let's start with the good news, and that clearly comes in from the crude oil prices. India being one of the major importers there, we have seen crude oil prices decline by 10% in 2023. This has been the first annual decline since 2020. Last year, we saw the prices gain up by 10% as well. So what we are seeing is, a narrow range coming into the markets. There was a lot of conversation that we could be looking at $100 a barrel. That did not happen. The range that we saw in the previous year was between 70 to 96 on the higher side. There are, of course, concerns about increasing global supplies and weak demand, and that is putting pressure onto those prices there. So while the previous year's range has been 70 to 96, markets do believe that this year as well, you could be looking at that kind of a range there. The U.S. production is at an all-time high at 13.3 million barrels per day. We also have seen a continuous decline in rig count in the previous year, but that doesn't really matter because even as we are working with minus 157 of a rig count, last year was an increase of 193, and before that an increase of 235. So if you look at those numbers, we still are on the higher side of rig counts and production that is coming in from US as of now. The other thing is about record production that we also are not just looking from US, but from Brazil, Guyana and Canada as well. So the non-OPEC production is expected to increase. Within OPEC as well, as this new year and new quarter begins, what OPEC and allies did put out in sense of an agreement was a cutoff 2.2 million barrels per day. If you look at that breakdown in various countries, the major heavy lifting is being done by Saudi Arabia at almost 100,000. We have seen Russia put in a big chunk as well. And then as we go down the list, it really is insignificant on what these members are doing. And also Angola leaving OPEC the membership is something that has put further pressure onto those prices as well. When you talk about the outlook in the next year, well, the average outlook for Brent for the next year, the most bearish of it comes in from Citi at $75 a barrel. And then you have 80 and 85 is what Goldman Sachs, JP Morgan, Morgan Stanley are putting in at. The most bullish that we've seen on the higher side clearly is 90 to 95. That comes in from Bank of America to Barclays. But as I said, most of these brokerages and banks believe that 70 to 95 is where you could be looking at the crude oil prices for this year as well.
Okay, got that, Manisha. Thank you very much for the updates over there. We do have to take a break on that note. We'll come back on the other side with our special segment. It's The Economy. Lata will connect with Jayant Kumar Seal, professor at the Indian Institute of Foreign Trade, and Ajay Sahai, Director General and CEO at the Federation of Indian Export Organizations, to discuss this Red Sea issue, the roadblocks and the slight recovery now and what lies ahead for India.